Next, we go on to the third one, which is return on invested capital. This is my favorite. What this does is it actually calculates how the whole business operates in an efficient manner. So it takes into consideration every working capital, every money that has been put to use in the company, every part that has been put to use in the company. The one that is not being used, like cash at hand, it takes it out. And the one that you're going to pay in the next few days, it takes it out. Such that what is left to measure the efficiency of the company is actually that amount of resource that the company actually employs to giving you that net income. That is what this does. So this has a bit of formula for calculation. So in this case, you need two things. One, invested capital. So your invested capital is all your assets, take away cash, take away cash equivalent, take away the non-interest bearing portion of the current liabilities. So what this means is you go to your current liabilities and then you look for the things that you need to pay within this financial year that the money is not available for you to use. So these are things like paying back the interest on a loan, or you have maybe tax that you have kept that you need to pay back in this financial year. You have various things, that are not bearing interest, but you need to pay right back in this current financial year. So invested capital becomes asset, which you find from the total asset of the asset side of balance sheet. Then the cash that is sitting there at the very top of the asset. Then these cash equivalents are mostly short-term investments. Short-term investments. So what some companies do is, rather than just have cash in the bank, they put it in very short-term investment that can be turned to liquid cash at a very short notice. Then the non-interest bearing portion of the current liabilities are things like when you have a loan and you need to pay that portion of that loan within that financial year, that itself becomes a current liability. That portion needs to be deducted from the invested capital because that money is not available for you to invest in running the business. Then other ones can be the income tax that you need to pay, the current portion of the your deferred income tax that you need to pay. So that too is not available for you. That gives you a rough idea of the invested capital. Number two, the other thing you need to calculate is what you call owner's earnings. Owner's earning was actually coined by Warren Buffett, and that itself has a root to a book written by a Scottish man called Adam Smith in the 1700s. He tried to explain that your real wealth comes from your net, and that whatever you put in your pocket after doing your business, you must consider the things that you use in running that business, like your stock, your the people who supply you, all those kind of things, how well you collect your money, and as well what you do to maintain your company, put it in order so that it doesn't fall apart. When you do that, whatever is left is actually what is in your pocket. So that is what you call owner's earning. This is quite different from your net income. Net income can be moved around, but your owner's earnings most definitely gives a truer picture of the performance of your company. So how do you calculate owner's earnings? You say net income plus your depreciation plus amortization plus non-cash charges plus changes in working capital. Changes in working capital, it can be plus or minus. Then take away the maintenance cost. So what it's trying to say here is that owner's earnings is an adjusted form of net income. Net income you get from your income statement, then you add anything that you have depreciated and all the amortization charges, you add them to the net income. Then non-cash charges. Non-cash charges are some form of cost that you have done before, but you are recognizing that now because maybe there is a loss and you need to, and that asset is not performing properly. You need to now shut it down, and what you need to then recognize is a cost for that lack of performance. So that is what you call non-cash charges. They take different shapes. Like for instance, when a company is shutting down a unit that is no more productive, or maybe when they need to write off a machinery. So these are called non-cash charges. In the income statement, you're not actually paying for it because you have already paid for it previously and it's sitting somewhere as an asset. But now the asset is needing to be written off or done with or shut down, whatever. So that you now need to recognize. Then changes in working capital are changes in receivables, changes in payables, changes in inventory. All this constitute your working capital. Of course, you can make a net income, a big net income, and then your changes, if you don't manage your working capital properly, your changes in working capital actually bring a whole lot down. So you can actually be a loss. At the end of the day, like in our cupcake business, we made such and such profit, but when we went through the cash flow, we ended up discovering that our working capital ate into all of our profit, and we didn't have, at the end of the day, we didn't have anything. We had no cash. We were crying. We had no cash, even though we made a net profit. Then this maintenance cost is a cost for keeping the asset alive, for maintaining your competitive advantage, for making sure that the company does not run down. So you need to keep maintaining and pushing it up. This is quite different from the growth cost, the growth capital. They call it the growth capital expenditure, growth capex. Those are two different things. Growth capex is to expand the business beyond its current capacity. maintenance capex is just what it takes to maintain it at its present capacity. So when you go to your cash flow statement and you go to the portion called the investing activity, what you normally see is a combination of your growth capital and your maintenance capital put together and called capital expenditure. The formula for maintenance cost, for you to be able to remove the portion of the maintenance cost from the capital expenditure in the investing activity, is roughly maintenance capex is percentage of depreciation multiplied by the net plant and property for the preceding year, all divided by 1 minus the depreciation percentage. So that value will most certainly give you a value close to your depreciation, which is the maintenance part of the capital expenditure in your investing activity. So if you now want to get your growth capex, you now say the capex from investing activities minus maintenance capex. So that gives you your growth. So this now tells you the amount of money you spend trying to make your business bigger. So that is that for the two things that you need to know in your return on invested capital. So return on invested capital becomes owner's earnings divided by invested capital. So if we make those adjustments, this would give you a true picture of the performance of that company. This is useful for most other companies. This is so useful. I see this as one of the quickest way to evaluating the performance of a company. The other one, return on assets, mostly is for banks. I mostly use that for banks. But I, for one, I'm not even too keen on banks because evaluating them is quite difficult, and because they have so many hidden things that they don't want you to see. They put themselves into derivatives, they put themselves into stupid mortgages, they put themselves into a whole lot of things. So so I don't really like banks as such. But for any other thing, this is your go-to formula. Thank you very much, ladies and gentlemen, for listening, and I hope you enjoy the rest of your day.